What's up, YouTubers? In today's video, I'm going to break down the #1 tax strategy for high-income earners in 2025. And this is going to be if you're earning 6 or 7 figures in your job or your business, and you tried everything that your CPA suggested or you read about online, like retirement account contributions, charitable contributions, HSAs, things like that, but it's just not making the impact on the amount of taxes that you're paying that you would like. You want to save more. This is exactly what this strategy is going to help you do. I'm going to break all of that down in just 1 minute. Hi, my name is Thomas Castelli. And before we get started, I invite you to subscribe to our newsletter for more tax tips. The link to that is going to be in the description to this video. Also, make sure to subscribe to the channel so you don't miss out on future tax savings videos. And also, if you have any questions or comments, drop a comment in the video, and I'm going to go ahead and answer as many of those comments as possible. Now, without further ado, let's go ahead and dive right into this #1 tax strategy, okay? And it's going to be investing in real estate, but not just any type of real estate. It's going to be specifically short-term rentals like you find on Airbnb or VRBO, okay? And why short-term rentals? Well, let's just start here, okay? If you invest in a long-term rental property, so your typical rental property with a 12-month lease, you're not going to be able to use this property to help you reduce the amount of taxes you're paying on your income from your job or your business. And that is because all rental properties under the tax code are passive by default. And what does that mean? That means if these properties generate losses, okay, it's not going to be able to help you offset the income that you're earning from your job or your business. But, and I'm going to get to the losses in a second. I know what you're thinking. Hey, Tom, I want to buy a rental property and I want it to generate cash for me. I do not want to buy a property and have a loss. But I'm going to break that down because this loss that I'm talking about is non-cash. But I'll get to that in a second. Now, the reason why short-term rentals work for this strategy is because if you have an average period of customer use of 7 days or less, okay, it's not going to be considered a rental property. Instead, it's going to be considered a business. And with businesses, if you have losses from a business, it can help you offset the income you're generating from other businesses or your job when certain criteria are met. And these rules were designed for hotels and motels back in the 80s and 90s. However, thanks to Airbnb and VRBO, today we can rent out a single family house, a condo unit, a townhome, so on and so forth for 7 days or less relatively easily. All right, so you buy a property, it could be a single family house, condo, what have you. You rent it out for an average of 7 days or less for the year. Okay, great. That's step one. Step number two. Okay, step number two, we're going to have to manage these properties. Okay, it's going to take a little bit of work, but we can always delegate some of the tasks to cleaners and repair folks as we go. And the way that you have to prove that you manage this property or you materially participated, as it is in tax language, is by meeting one of the material participation tests. And the three most relevant for everybody here watching this video is going to be you're spending more than 500 hours managing this property, or you're doing substantially everything yourself. So you're a one person show, just kind of making it all go, or you're spending more than 100 hours on the property for the year and no one else is spending more time than you. This last one is by far the most popular test out of all of these because you can manage the property yourself, but delegate the cleaning and other repair tasks to other people and still make this all work. Once you do those two things, average period customer use of 7 days or less on your short-term rental, and you're self-managing it, meeting one of the tests that I just mentioned, then the losses on your property are going to now be what they consider non-passive, and they can offset your W-2 or active business income. Okay, now back to the losses. Tom, I don't want losses. I want to generate money from my property. And that's all well and good. And I understand that. So the way we generate losses on these properties is through an expense called depreciation. So depreciation tracks the deterioration of your property over time, but for tax purposes, it is a non-cash expense. That means it only shows up on paper. So you could very well be generating positive cash flow, so putting money into your pocket, despite the fact that you're telling the IRS that you're losing money. And depreciation is something that you have to take. It's very common with rental properties and most physical assets. Okay, so the way this depreciation works is that it's going to reduce your taxable income on your rental property, often causing a loss. And remember, this loss is going to be on paper only. And thanks to something called bonus depreciation, this loss can be substantially increased because you're able to depreciate a bulk of your property all in the first year you acquire it. And in 2025, everybody's expecting 100% bonus depreciation to return. And if it does, this means that you're typically going to be able to depreciate somewhere between 20 to 30% of your property's value in the first year. This creates substantial losses. Oftentimes, a loss is so large that it saves investors 5 to 6 figures in taxes. So this is the number one tax strategy. Just to summarize and wrap it all up, it's investing in short-term rental properties and keeping an average period of customer use of 7 days or less for the year. So not just 7 days or less, but for the year. Okay. Then you are materially participating in your rental property, or in your short-term rental rather, by meeting one of those 3 tests, with the most popular one being you're spending more than 100 hours and no one else is spending more time than you. And then you're using bonus depreciation to generate non-cash losses that only reduce your income on paper, not your actual income that you're actually making, or cash flow that you're actually making, and using this loss to offset the income that you're earning from your job or your business. And that results in significant tax savings, often up to 5 to 6 figures. So if you do have questions on this strategy, go ahead and drop a comment in the video. I'm going to be answering as many comments as I can. Also, we do have a book called Short-Term Rental Tax Secrets that breaks this strategy down in excruciating detail so that you can use it to actually reduce your taxes. And last but not least, if you do want to shortcut the process, if you just want someone to tell you exactly what you have to do for your situation to implement this strategy and others to help you reduce your taxes, go ahead and request a free initial consultation with our team. You can do that by clicking the button below this video in the description. I look forward to seeing you in future Tax Smart videos to help you reduce taxes. That's it for today, and I'll catch you on the next one.